Have you ever stopped to wonder what a company is really worth? I mean, it seems simple enough, right? But what if the way we've all been taught to measure value, with balance sheets and profit margins, is actually missing a huge piece of the puzzle? In this explainer, we're going to start with the absolute basics of business and end up with a totally radical way of rethinking our entire economy. So let's just dive right in with that big question. What is a business truly worth? Is it just the cash it has in the bank, the buildings it owns, the stuff sitting in its warehouse? Or is there something more to it? This one question is going to be our guide as we go from a simple accounting ledger to a whole new vision for the future. All right, so before we can start talking about redefining value, we've got to get on the same page about how it's traditionally measured. And that means we need to start with the most fundamental document in all of business, the balance sheet. It really just comes down to two simple things: what a business owns and what it owes. At its core, it really is this simple. On one side, you've got your assets. This is all the valuable stuff the company owns: cash, equipment, property, you name it. And on the other side, you've got liabilities. That's just what the company owes to other people, like loans or unpaid bills. It's this balance between the two that gives us our first real snapshot of a company's financial health. So let's break that down a bit more. Assets can be current, which means they're easily turned into cash. Think inventory you're about to sell. Or they can be fixed, like the building or the delivery trucks. And it's the same deal with liabilities. Current liabilities are things you need to pay soon, like this month's wages. Long-term liabilities are the big ones, like a mortgage you'll be paying off for the next 30 years. Okay, so you have your assets and you have your liabilities. In the traditional business world, what's the whole point? Well, it's to use what you own to do one thing and one thing only: make a profit. At the end of the day, it's all about that bottom line. And profit is pretty much exactly what it sounds like. It's the money that's left in the pot after you've paid all your bills. It's simply what you brought in minus everything you spent. And for literally centuries, this one number has been seen as the ultimate measure of whether a business is a success or a failure. Let's take a super simple example. Say you start a t-shirt shop. In your first year, you manage to sell $100,000 worth of shirts. Awesome. But of course, you have to subtract all your expenses: the cost of the blank shirts, the rent for your shop, your employees' wages, taxes. It all adds up to $79,500. So the money left over, that $20,500, that's your profit. But hold on, because this is where it gets really interesting. That $20,500, that's your accounting profit. It's the number you put on the books. But economists, they look at things a little differently. They subtract something called opportunity costs, which is really just a fancy way of asking, what did you have to give up to start this business? So in this case, maybe you gave up a steady job as a nurse that paid $45,000 a year. Well, when you factor that cost in, your t-shirt shop actually has an economic loss. And this little shift in thinking forces us to ask a much, much bigger question. All right, time for a major pivot. We're about to zoom way out, from the balance sheet of a single little t-shirt shop to the entire blueprint of our economy. We're going to move from the simple idea of assets to a much bigger, much more powerful concept: capital. And this brings us right back to that central question. But now we're looking at it through a new lens. Are a company's physical things, its buildings, its machines, its cash, are those the only things that create real value in our world? Or have we been missing something huge this whole time? To figure this out, let's go way back to where the word capital even comes from. It comes from the Latin word caput, which means head. And this is perfectly captured by the idea of an ancient herdsman. His wealth, his capital, was literally the number of heads of cattle he owned. When times were good, he could live off the surplus, the milk and the new calves. But if there was a drought, he might have to eat into his capital to survive, a phrase we still use today. So here's the absolute key idea. Real capital isn't just about money. It's any stock of wealth that can generate a flow of benefits over time. For the herdsman, that stock of wealth was his cattle. For us today, it could be a healthy forest, a good education, or even a strong, tight-knit community. And understanding this, well, it changes everything. So what happens when our whole economic system kind of forgets this broader, more ancient definition of capital, and instead just focuses on money and machines? Well, that's when you start to see some serious problems pop up. Let's take a look at the modern critique of that system. This diagram here shows the basic logic of our conventional economy. Just follow the arrows with me. You start with capital, things like factories and money. People, acting as labor, use that capital to make stuff. And what's the primary goal of this whole cycle?
It's what the diagram calls out money, which is just profit for the owners. It's only after all of that, way at the end, that we get to people as beneficiaries. The crucial thing to see here is that human well-being isn't the goal, it's just a byproduct.
And this model leads to 4 really critical malfunctions. First, people get sidelined. Profit is the goal, not our well-being. Second, it's built on some shaky assumptions, like the idea that an invisible hand will magically make everything fair. Third, it operates as if our planet has infinite resources, completely ignoring the physical limits to growth. And finally, it tends to concentrate wealth, making the rich richer and leaving others behind.
So, if that old model has some serious flaws, what's the alternative? Is there a better way? Let's explore a new blueprint, one that's designed to keep both people and the planet healthy for the long run.
The new logic completely flips the old way of thinking on its head. The old model basically said, let's focus on making a profit, and hopefully some benefits will trickle down to everybody else. This new model says, no, let's focus on making sure all our essential stocks of capital are healthy and strong, and then human well-being will naturally flow from that. And you can see that new logic perfectly in this diagram. Just look at the difference. We start with 5 different kinds of capital now, not just factories and money. And look where every single arrow leads. They all flow directly into people as beneficiaries. In this model, our well-being isn't a happy accident. It's the entire point of the system. So, what are these 5 capitals? Well, first you have natural capital. That's our planet, clean air, fresh water, all of it. Then there's human capital, our health, our knowledge, our skills. Third is social capital, our families, communities, and trusted institutions. Fourth is manufactured capital. That's the traditional stuff, the tools and roads and buildings. And last, and this is key, is financial capital, which is seen not as the master, but as a servant, just a tool to help us value and exchange the other 4. So what would a world actually built on this model look like? This chart gives us a little glimpse. Instead of just tracking GDP growth, we'd be tracking whether all our capital stocks are healthy. Is our human capital leading to good health? Is our social capital giving us trusted governance? Is our natural capital protecting biological diversity? It's a vision of an economy that truly works for us, instead of the other way around. And all of this leaves us with one final, really powerful question. Is it actually possible to build an economy where making a profit and having a sustainable world aren't seen as enemies? Where a healthy planet and healthy people aren't just costs on a balance sheet, but are recognized as our most valuable assets? The theory says yes. But making that theory a reality, well, that's up to us.